Welcome everyone. My name is Blake and I will be your moderator. Today we're joined by Dr. Tom Snyder and Dr. Ashley for advice on selling your practice. Before we get started, I'd like to note that Henry Schein is not offering CE credit for viewing or attending this presentation live or on demand. Welcome and thank you for joining us. I will pass it over to you now.
Hello everyone. Thank you for the introduction. Dr. Ashley and I are happy to be with you today. We have lots of information to share with you about are you ready to sell your practice in 2023. As you can see, we're going to cover a lot of ground, and some of the key points that we'll be covering with you are understanding the market for practice sales in 2023, determining the key questions you must answer to successfully execute your transition plan, learn key strategies you must consider to better position your practice for sale, using a broker to sell your practice, understand the major components of a practice purchase agreement, and then finish off with understanding common tax allocation strategies. So as we all know, depending whether you've been in practice 10, 20, 30, or 40 years, some of you have seen sea changes in our dental profession. Others who may be younger are seeing lots of changes, but not as many as those who graduated perhaps in the 60s and 70s and perhaps even in the 80s. So lots has happened in our profession, and changes are going on at a rapid pace. So let's look at what I consider marketplace realities. In our experience as brokers, and we do about 300 practice sales a year, so we kind of know our market nationwide, and we still can report to you that it is a seller's market in most markets. It's been that way for a while, and I think at least for the next few years, I think we'll see a seller's market. However, there are some things that are going on in our marketplace which may change that dynamic a bit. There are some major exceptions though. If you're practicing in a small town or rural area, and you probably are aware of this fact, it's hard to get an associate. Furthermore, more complicated and challenging if you want to sell your practice. So consequently, in those areas, the sale prices are not at high levels. In fact, some doctors are almost willing to give their practice away, which is unfortunate, but that's just our new generation of dentists, and we'll talk about that in a few minutes. Another contributing factor, not only for supply and demand, because there's really a lot more buyers out there than sellers, DSOs, especially over the last 10 years, have been driving up sale prices in many markets because there's a lot of competition. There are new DSOs emerging almost every month. They have lots of private equity capital, and so they have money, and they want to gain market share. So oftentimes you have DSOs competing for a practice in a highly competitive area, and that does result in the selling doctor getting a very high price. So that's another factor that really does contribute to the high prices that we see in most parts of the country. However, as I said a minute ago, we are beginning to see a shift regarding the annual number of retirees versus dental graduates. Up until now, we've had more dental graduates than retirees, but that's starting to change. And why? Well, the American Dental Association Health Policy Institute does a lot of surveys, and some of you may have participated in their pandemic survey and now their economic recovery survey. And what they're finding is that with dentists over the age of 55, there is going to be a real influx of retirees over the next 5 years. So that trend is going to continue, and that's the point where maybe in a few years we'll begin to see more retirees than dental graduates, and that could change the balance of the supply-demand equation. Also, we are seeing more increases in consolidation due to the economic pressures and staffing shortages, meaning the corporate dentistry is gaining market share and purchasing more practices. And we're going to talk about that tonight because some of you may be considering a corporate purchaser as your exit strategy. So this is a slide that just shows you how things are changing. If you look on the left, that's 2018, and the lighter blue are the number of dental graduates, and the darker blue are the number of retirees. We can see that in 2021, that it's just about even. And I'm sure if we look at next year, we're going to begin to see that dark blue bar being higher than the bar of dental graduates. So that's kind of what's going on right now. Now, if you're a solo practitioner, I have a few things I need to share with you. You may or may not be aware of this. For those of you who've been in practice a good 30, 40 years, you remember that almost everybody in your class wanted to be a solo practitioner. That was the model. Dental schools actually recruited candidates that had that individualistic personality, like go it alone, work your own thing. Well, that's changed. And as of 2021, only 42% of dentists were considered solo practitioners. That is really a big decrease since 2001. That's almost a 21% decrease over the last 21 years. So obviously there's less and less dentists who are considered solo practitioners, because those dentists who are solo practitioners are in that 55 plus age group for the most part. So that particular type of practice style is retiring out. And so we're finding that young dentists, specifically, again, from the ADA, for dentists under the age of 35, only 1 in 5 desired to be a solo practitioner. So that is a very small number. So our dental graduates of today want to work in groups. They don't want to work by themselves. So that's another trend, which may mean as a solo practitioner, you may have some problems finding a qualified purchaser to buy your solo practice, particularly, again, if you're in a smaller town or rural area. But even in urban areas, depending on the quality of that practice, that may be a challenge. So at least it's something you need to be aware of when we discuss the planning for your transition. Another interesting statistic, and it really is a trend, we find that ownership rates for male and female dentists continue to decline. For example, in 2021, 60% of females owned a dental practice, whereas in that same year, 80.3% of males owned a dental practice. So the trend continues where more young doctors do not want to own a practice. Does that mean they'll never become owners? Well, one of the hypotheses may be that with the high level of educational debt, maybe younger doctors initially are working in a practice or a corporate group to help pay down their student debt. And that maybe a few years after dental school, they may start to consider ownership. But at least right now, this is what the statistics show us. So you can see that is a big change. Also, as far as our recent graduates are concerned, they're 3 times more likely to seek employment in large groups than they were 10 years ago. Again, with the emergence and market penetration of corporate dentistry, there's lots of career opportunities for these young doctors, especially those who have a lot of debt, which we'll cover in a second. To the extent that the class of 2022 was surveyed, and 30% of that class planned to join a DSO upon graduation. Again, looking at our newer doctors, they prefer to live in urban and suburban areas. They want lifestyle and quality of life, even though they could go to a small town and rural area and be financially independent, probably or 10 or 15 years, because of the profit they can make on their practice, because there aren't many dentists, so patients will flock to them. That's the problem. It's a problem so that the small town or rural area doctors are having a harder time to find successors, and that's the reason, because our dental graduates don't want to live where these doctors set up a practice. Now, here's some sobering information on education debt. This is the class of 2021, so it's pretty current. The average debt of all grads was $301,000, rounded. Obviously, public institutions' debt was lower at $261,000, and private institution debt averaged $355,000, that is. But if you look at the class of 2021, 17% of that class had zero educational debt. So that's something that we're seeing, that there seems to be a growing percentage of graduates who have no educational debt. But of course, we have a lot of doctors who owe a lot of money. The good news is that banks know these stats, and they're certainly going to make practice acquisition loans to doctors who may owe $300,000 or $400,000. There's a myth out there that if you're in debt, you'll never be an owner. Well, we don't subscribe to that theory, and if you talk to the major dental lenders, they won't agree with that hypothesis either. Let's talk a little bit about what dental practices are worth. Some of you may have attended a recent webinar that I did on practice valuations, so we're really not going to go into the weeds on valuations, but just to kind of give you some summary points for planning purposes. The majority of dental practices that we find are valued between 70 to 85% of prior year's gross revenue. For specialty practices, I'd say that number is probably 65 to 80. However, in certain parts of the country, that ratio can be even higher. Where I live in Northern Virginia, we see values at 90%, sometimes even higher. You could be up in Maine, coastal Maine or interior Maine, and you're lucky if you could see 60%. So my point is, where you practice will dictate the value that you're able to command. Again, what does it relate to? Supply and demand. The more buyers, the higher the price. The less buyers, the lower the value or lower the price. Now, just to let you know, when we value a practice, and we do almost 900 dental practices a year, there are three common valuations that we use when we value a practice, and what we call a doctor-to-doctor sale. That is what we call a private sale. And we'll go into the other format in a minute. So the first method we use is the market approach, where we're using comparative statistics from databases that we subscribe to, plus our own database, to determine what we think your practice is worth with a certain profit margin that you may have in a particular area where it's located. The income approach looks at the true cash flow from your business. And when people invest in buying a dental practice, and when banks underwrite a loan for you to be bought out, they're going to look at your cash flow. So the income approach is a method that tells how profitable you are and what kind of cash there is to have a value attached to that. And the third method is the asset approach, where we look at the value of your tangible assets, your clinical office equipment, clinical technology, and inventory, plus your goodwill. And we average that and come up with what we consider a transactional value. Now, for those of you who have been approached or will be approached by a DSO, when they value a practice, they don't use those three methods. In fact, what they typically do is they'll gather your financial information and they will do calculations to come up with an Ebitda. An Ebitda is earnings before interest, taxes, depreciation, and amortization. It looks at the financial strength and the cash flow generation ability of a business. So the Ebitda for general practices can go anywhere from 4 to 6. That's a multiple. So if your profit was $200,000 or your Ebitda was $200,000, that practice value could vary between, for example, $800,000 to maybe $1.2 million. Again, there's so many factors that really push this Ebitda. It's not so much for us to get into a full description, but just let you know that a corporate purchaser is going to look at your practice differently than if you were doing a private sale to another doctor, where we would use our three methods. So let's talk about, is it time? Is 2023 going to be the year that you're going to make that decision to sell your practice? Or are you just fact-finding this evening, getting an idea? Maybe you haven't had your practice valued, and we certainly recommend you do. And maybe from that valuation, you'll get a feel whether you think your practice can give you the price that you're looking for, or must you make some enhancements, which Dr. Ashley is going to cover in a minute or so, as far as making your practice more valuable so that when it's time to sell, you hopefully will get a better price. So there are several key questions that we think need to be answered before you start this journey. Number one, have you retained a financial planner? You know, we're firm believers in transition as well as financial planning. Financial planner, if you've engaged one, know it's like getting a comprehensive physical. You give them a lot of documentation. They sit down with your spouse, if you're married, review your plans. You have children, how many children they educated yet, marriages come on board, estate plan, things of that nature. And of course, they look at what your net worth is, and part of that net worth is your dental practice, okay? So you really have to sit down and understand what your goals and targets are, because that's what a planner will do. They'll be able to look you in the eye and say, Tom, you know, with the goals that you have where you want to, you know, do a lot of traveling when you retire, you're going to need another $1 million in your retirement plan because the numbers won't work. Most financial planners now are planning to the age of 90 to 100 as far as your mortality. They use mortality tables, and that's how they come up with whether or not there's enough money for you to have an enjoyable retirement, okay? So another big question that we face is when we do our transition planning, and we ask this question of our prospective clients is the sale of your practice a financial necessity or simply a quality of life decision? Now, why is that an important question? Well, it's an important question because if it's a financial necessity, it means you need $1 million, let's say, for your value of your practice. You won't accept 800,000 or 850 or 900 because you need to have that $1 million because that's what you need to make the numbers work. Versus, listen, I've done a great job. Fortunately, I've done well with investing. I saved early. I've taken care of most of my planning objectives, meaning education of children, things of that nature. And so I want to sell my practice to someone who I like and someone who can be a good steward of my legacy. And I don't need top dollar. It doesn't mean that we're going to, if we sell your practice, we're going to try to sell it at a discount. But what it means is for you to pull that trigger to sell, you've got to have that equation answered in your head, either necessity or quality of life. And of course, as we mentioned before, have you had your practice valued? Now, timeline for sale. Many doctors say, gee, you know, I want to sell my practice. Can I get out in 3 months? Well, if you want to get out in 3 months, unless you're in the most highly desirable area in your market, it may not be that easy to do. We find that the sales cycle will vary between 6 to 12 months. Does that mean it has to be 6 months? Of course not. As I said before, if it's in a highly competitive area, that can happen in 3 to 6 months. But 6 to 12 months is a good time frame to think about how long you have to continue practicing before you can retire. And of course, again, hate to bring that word up about it, but it's location. Again, small town, rural area, it's certainly going to take longer than that. It may take up to 2 years to find someone. Again, these are things you need to put in your equation as far as consideration. So now I'm going to turn the reins over to my colleague, Dr. Maria Ashley. Dr. Ashley had been a private practice owner. She is now a practice development consultant for Henry Schein One, and she has some really good things she'd like to share with you. So I'm turning it over to you now, Maria.
Thank you, Tom. And I just want to apologize to everybody for my voice. I am recovering from a very bad cold, but I am very, very happy to be here with you, share what information I can to hopefully guide you along your path. I sold my practice in 2019 after 33 plus years of solo practice and quite a few years of thought and preparation, to be very honest with you. Like Tom just mentioned, however, my first thought was, am I financially prepared? And thank goodness I was. I had reconciled the list that he just mentioned. But one aspect that I had not really considered so thoroughly was the emotional and the mental readiness that part involved with the transition. So we have to ask ourselves, are you emotionally and mentally ready to make that move? Now, many of us really routinely feel the physical strains of chairside dentistry, and our bodies may be saying it's time to go. But emotionally and mentally, are you prepared for the big change that's going to happen in really the only life that you've known for the past 30 plus years. So can you relinquish the power and ownership control? Now, this is bigger than you may think. I struggled a bit with it, but honestly quickly got over it. It isn't that it's necessarily an ego thing of not being doctor anymore. It's just been our identity for several decades. And I believe for most of us, a very highly respected identity. We worked really hard to get our degrees and establish our businesses and represent ourselves as, what I believe to be pillars in healthcare. So yes, that will change, but it can be changed with a new identity. Maybe it's a new identity to discover a long lost hobby or a bucket list item that we've been waiting to pursue. Now, if you plan to stay on, can you actually deal with the shift of attention from you to the new head doc in charge? Again, this can be very difficult if you remain in the practice. You will have to be prepared to take a back seat to the new owner. Their choices and decisions that they make for the practice may be very different from what you would do. You must be able to play nice, show respect, but also use this as an opportunity to serve as mentor, to share your many years of wisdom and guidance to your new owner. Now, life, of course, does not end with the sale of your practice. It's just a transition to your second act. There are many opportunities even to stay within our industry to work if you so desire, as I did in consulting. There's academia, there's consulting, there's clinical volunteerism, or again, you may just want to take that time to spend with your family and maybe renew some old hobbies that you enjoyed in your pre-practice lives. Now, if you are emotionally prepared, there we go. Is your practice prepared for this transition? Do you know what your practice is doing? So, is your practice not only ready for the transition, but for what we want for you is the best transition? So often, because we as dentists become so focused on doing the dentistry, we lose sight of the analytics or the business part of our practices. So do you know your numbers, your KPIs, your key performance indicators, and how they compare to the industry standards? So what are KPIs for dentists? For the most part, the big ones: production, collections, or your accounts receivable health, new patients, of course, active patient base, patient retention, and case acceptance, just to name a few. You will want to spend time improving as many of these KPIs as possible to make sure your practice is most attractive to a buyer, ultimately being more valuable to you. Now, HS1, Henry Schein One, was the practice development company that I work for now. We have a team of profitability coaches that work very closely with our Dentrix and Ascend offices to review these numbers and implement immediate solutions and even long-term practices for improvement. This allows you to work with an expert to really get your practice ready for sale. Now, here are some numbers I'm going to throw out there for you just to consider. What is your active patient base? Okay. Active patient base in dentistry is the number of patients that you've seen in your practice within the last 18 months. Now, in dentistry, we consider for a typical full-time general practice a healthy, stable, active patient base to be anywhere between 1,400 and 1,600 patients. Now, I know there's no typical practice, but these are just guidelines that can be considered when determining the health of your business. Collection, revenue. It was just stated by Tom earlier that one valuation method is based on percent of gross production. Do you know what your gross production and your adjusted production is, and how much of that you are collecting? Is the data being tracked and evaluated correctly? This data, these analytics can absolutely matter in the course of your valuation and your practice sale. One other thing that I was kind of unaware of when I was selling my practice were patient credits. This is a big data point. I needed help reconciling this. Most states have very strict laws governing the reimbursement of patient credits. I had to work to start getting a system in place in order to refund some of those credits or transfer them to my buying doctor. So these are just a few things that you can prepare several years out before the actual transition of your practice to make sure that you've got a healthy practice to sell, ultimately getting the best value for it. Now, have you thought about your new patient numbers or your patient retention data? All of these things are very important to know when you want to sell your practice. Again, our profitability coaches work one-on-one with our Dentrix and Ascend practices to help you discover all of the possibilities for your increased growth, production, and efficiency for your practice. Now, as we move on, if you want to continue practicing in your practice after the sale, if this is a consideration for you, there needs to be an ample active patient base to support you staying on. This number, again, can be determined with the help of one of our coaches or your transitions consultant. You'll also want to make sure that you find a like-minded doctor to sell your practice to and continue to work with. For however long you are there, it must be an amicable relationship for the success of not only the transition, but for your patients and for your staff. So there are several ways that you can transition your practice. Tom will take it from here to discuss some of those additional options that you have at your disposal. Tom?
Thank you, Maria. Appreciate that. So let's talk about selling your practice. We're going to look at two ways. 20 years ago, it was always a doctor to doctor, or what we call a private sale. Today, that's not the case. So we'll be talking about selling to another doctor or selling to a corporate group or DSO. So if it's a doctor to doctor, a private sale, there are several ways this can be accommodated. One is called a walkaway sale. Because of the size of the patient base, there's only room for one doctor. You might stick around for a month or two to finish some cases, but by and large, that new doctor who wants to practice 4 or 5 days a week no longer needs you. However, if you have a good-sized patient base, a role reversal sale may work, meaning you can be retained for a period of time as an employee in your former business to help with patient care. And as Dr. Ashley said, it's all about the size of the patient base as far as whether you can remain or not. And of course, if you are going to retire completely, what becomes important is transferring as much goodwill as possible, particularly if that doctor has never worked in the practice before as an associate, be it whether full-time or part-time. So there's a complete stranger. So the ability of you to communicate the transfer of your patients to this doctor is extremely important. It must be well written. Staff have concerns about you retiring, and that's why oftentimes for solo practitioners, we will communicate with them initially via cell phone after hours or on weekends because they don't want their staff to know about their plans because they're worried about loss of patients. Loss of, we're going to start this slide again.
Okay.
Okay. One, two, three, we'll start. When we work with solo practitioners, oftentimes initially, we will communicate with them only by cell phone, after hours, or on weekends. Why? Because they do not want their staff to know that they have plans about selling their practice. And of course, they're worried about their staff leaving because maybe they think the new purchaser will fire them because they are a highly paid person, they have a lot of fringe benefits, so they may decide to look elsewhere. So that is a big concern, loss of job. And of course, with staff, do they have an ability to work with that purchaser? Time will only tell, particularly if it's a new person. And of course, one of the things that staff are concerned about with a new buyer is loss of benefits. And where we see this become an issue is when the selling doctor had a very robust and generous retirement plan for both himself and staff. That can become a problem that has to be negotiated around. Now, for those of you who own real estate, big question is, and this goes back to your financial planning, with your planner, if you own property, whether it's a solo use property or multiple tenant property, does it make economic sense to sell the real estate along with the dental practice? Okay, years ago, with higher interest rates, it was usually a 1-2 step process, meaning step one, sell the practice, and maybe in a couple of years, sell the real estate because the cost of borrowing was so high. But the good news is, even though interest rates are ticking up, we still can get very favorable interest rates to purchase a building for the buyers. If you do not want to sell, and or the purchaser does not want to buy, you then become the landlord, in which case you will more than likely offer that individual a future purchase option to buy your practice. However, we do not recommend that you lock in the value of that real estate in today's prices, that they will have appraisal done when it's time to sell. So that's what you should include in the future purchase option. In rare cases where the property value is greater than your practice value, that could be a difficult situation because banks may have a hard time loaning the entire amount for both assets to be purchased congruently. So if you are the landlord, your lease must be at least identical to the number of years that the buyer has the practice acquisition loan. So if it's a 10-year term, it could be 1 10-year term or 2 5-year terms with renewals. It has to be congruent with that time. Rent has to be comparable to other professional practices in the area. Even though you may have owned the building, and let's say you had your own LLP, you and your spouse owned the building, and you paid yourself an exorbitant rent, you can't expect that exorbitant rent post-sale. If you're the landlord, it's got to be comparable to what other doctors would be paying as tenants. Now, for those of you who are contemplating or are in the process of selling to a DSO, there are some significant differences. Obviously, it stands to reason a much more complicated process, and we'll talk about a couple of points there. But one of the most important things to consider in the sale to a corporate group is the time period they're going to require you to remain. Back in the early days when DSOs came on the market, some of the legacy groups that are out there didn't require their doctors to stay for maybe more than a year or two, maybe 3. But they've learned that in order to replace high-producing doctors, they need to find high-producing associates, which may or may not be the easiest thing to do. So over time, most of the DSOs have changed their format whereby they're going to usually ask you to remain for 5 years. Now, it doesn't mean you can't negotiate a little less than that. Maybe you won't get the same price, but by and large, they are looking for at least a 5-year time period. Additionally, we're finding that most of the corporate groups are targeting younger practitioners in their 40s and 50s because they want to keep them for a while. In fact, they term their acquisition as a partnership, whereby given the economic and financial structuring of the deal, you'll be involved with this DSO in more ways than one for a longer period of time so that they don't have to go out and constantly replenish the well if you were to leave prematurely. Obviously, you all know this, that you certainly can get paid a higher sale price by selling to a DSO, maybe 125% of last year's gross receipts, maybe even 150%. But remember, unlike a private sale, where when you retire, you get paid cash at closing, you're not going to get 100% in cash. You're going to get a percentage. And that percentage can vary anywhere from 50 to 60, maybe 70%. Again, there's so many DSOs out there. It's all about what they're looking for, what their model will allow, and what you're willing to accept. So you have to keep that understanding. Additionally, we're seeing more strings being attached now to sales to DSOs. For example, we see in some cases that a certain percentage of the seller proceeds are invested in the buyer's entity, and their DSO, and that's called rollover equity. You can't transfer that, and you have to stay for the period of time until there's a liquidity event, meaning they're going to sell that DSO. As some of you know, DSOs are like a fund, and that fund usually has a shelf life, can be anywhere from 5 to 10 years. And so what they do is they acquire a lot of inventory. They try to get a higher Ebitda than they bought your practice for. That's how they make their profit. So now new ownership comes in. Of course, if you have a rollover equity and there's an event, then you're going to get a nice payday on the amount of equity you have when that event occurs. Some others will do what are called holdbacks. Maybe there's some things in the transaction they weren't happy about, so they're going to hold back a portion of the sale price for you to meet certain criteria. Or there's also called an earnout, which allows you to earn even more money if you're staying on, and based on how you grow the practice, will you be more involved in managing the practice? Some DSOs want you to be actively involved in management. Some you'll turn everything over to their staff. So there's lots of different things. But again, remembering that the normal employment period is now 5 years. Also, you're going to sign a restrictive covenant, and they are much more involved than a covenant in a private sale. For example, if there's multiple locations, you may be restricted from working at any area that has one of their facilities. We've seen that happen before. One thing too, and we talked about the time it takes to sell. Usually when you're selling in a corporate model, it's going to take a little bit longer because there's so much more due diligence that is done. They bring in accountants, financial people, and they do what's called a quality of earnings analysis. So they really, really take a look at everything. So it does take a little bit longer. And of course, it stands to reason, since these deals are highly complicated, you can expect to pay a substantially higher professional fee with accountant and attorney fees. Hopefully you'll hire dental-related people who have worked with these companies, but that's just a transaction cost. Of course, if you're going to get a higher sale price, then it stands to reason if you have to spend more, it's well worth it from a cost-benefit point of view. Now, let's talk about if you own the real estate in a DSO sale. Not all DSOs want to purchase real estate. Some will just enter into a long-term lease with you, and from a financial planning point of view, maybe that's not so bad, because now, instead of paying yourself a rent for your whole life, now you have the company who bought you out paying you a fair market rent for 5, 10, 15 years, and that may not be a bad deal. And then if you sell it, you can sell it on the open market, and of course, that may be good for them because they'll just become the tenant of the new owner. However, some DSOs have affiliated with real estate investment trusts, and what that means is that REIT, R-E-I-T, will actually buy your building. And so you'll have a liquidity event after you sell your practice. Shortly thereafter, the REIT buys it. The REIT goes into a long-term tenant relationship with the DSO. The DSO pays them a rent. So that there is a way that you could liquidate your real estate with some DSOs if they had that relationship. And of course, remember that having a long-term lease may probably be pretty good as far as your financial planning. So now let's talk a little bit about the nuts and bolts of a practice transition. And as I said before, 6 to 12 months, maybe 3 to 6 months if you're lucky, is a time frame. As you can see from this chart, there are so many things that are going on Obviously, we're just going to touch the surface, but just to give you an appreciation of the complexity of a practice sale, it's not just finding a buyer and going to closing. There's a lot of steps in between. Finding a buyer, whether you use a broker or not, and we'll talk about that shortly. Getting the right candidate with the qualifications, making sure they're financially qualified, coming up with an offer for you to consider for purchase, having that buyer get adequate financing. Is there going to be a real estate transaction, or must you deal with a corporate landlord and work out a new lease for the buyer? There's the due diligence that the buyer has to participate in, and there's a lot of contract work in terms of the different agreements. And we're going to cover a couple of those just to give you an appreciation of what's involved. Talk for a second about banks, because obviously everybody knows we have inflation, and whether we have a recession or not, or now, pundits are debating that, but be that as it may, interest rates are creeping up. The good news is, as of today, we're finding that most dental lenders, okay, and I want to emphasize dental lenders, where they're used to working with dental practices. They understand that there's minimal business failures with dental practices for the most part. They understand what's going on in a dental practice. They'll look at production reports and things. They're pretty thorough. And what many of them do is loan 90 to 100% of current gross receipts, meaning if your practice is grossing $1 million, and the value, let's say, was $900,000, they may loan up to $900,000. Not all of that will go to you in the form of a practice acquisition loan to be paid by the buyer to you. However, they may take $100,000 and allocate that to working capital. But the point is that dental lenders understand what the marketplace is like, and they're going to look at 3 years of financial performance. Obviously, looking at 2021, and 2020 is an aberration, as we all know. What they're looking from 2020 to 21 is what kind of a rebound did you encourage, and of course, what do your year-to-date performance numbers look like? Right now, most loan rates vary between 4 to 5%, but my guess is after the new year, it might be the mid-4s to mid-5s. Who knows what the top line is going to be, but being in this business as long as I've been in, I can only tell you, we used to have double-digit loan rates for practice acquisitions, so a totally different landscape that we're living in right now. Of course, if the buyer has some risk characteristics associated with him or her, they may charge a higher rate. The banks are looking for a debt-to-income ratio of 1.25. That's their standard. Some banks do require what's called liquidity, meaning that the buyer has to show evidence of some liquid assets anywhere between 5 to 10% of the loan amount. Loan terms with some dental lenders may extend up to 15 to 20 years, allowing some qualified purchasers to buy a very high producing practice and pay for that almost like buying a mortgage. So that's the good news, but traditionally most lenders are in the 10-year time frame. There are some problems that may occur if you are a tenant and you have a landlord who's not cooperative. So sometimes that takes a little bit of negotiating to get a proper lease for the new purchaser. Now let's talk for a second about using a broker. Obviously, as most of you know, we are in the brokerage business and we get paid a commission to find the appropriate purchaser for your practice and hold their hands and your hands to get the job done. So let's look at a couple things that need to be considered if you're thinking of retaining a broker. As much as we like to do what we do as brokers, we understand that the majority of practice sales in this country are still completed without a broker. Oftentimes it may be your accountant who has a good practice with a lot of dental clients, maybe decides to kind of facilitate some deals on their own. Maybe your attorney, or it just may be a doctor to doctor. So there's still a lot of deals that are done, the majority of the deals done, quite frankly, without a broker. Obviously, when you are considering this, if you're doing it on your own, you've got to do all the work by yourself, finding that buyer, negotiating, all the kind of things we've been talking about. And if timing is an issue, you may consider using a broker. Now, by that timing, I mean, I want to sell my practice in 45 days, I'm going to hire a broker. Most brokers won't accept that because it takes a little while to get ramped up, get the valuation done and all the other things that need to be accomplished. So the timing would be a year or less that some people will consider using a broker for that reason and that reason alone. Again, it depends on where you're located, whether that's a reality. And just like anything else, you'll pay a commission. Commissions vary all over the place. We have discount brokers that 5 to 10% seems to be the range around the country, and it's all about what you get for what you're paying for. And you have to measure the cost versus the benefit. What's it worth for you to pay someone to find your successor? There are some brokers that do what's called dual representation, where they say, well, we work with the buyer and the seller. And then if that's the case, you need to ask the question, are the purchasers paying a fee? In other words, some brokers will say, well, we'll charge 10% and the seller will pay 5% and the purchaser will pay 5%. So again, it just depends on what you're looking for. Do you want someone who's 100% in your corner to get the maximum price for you, or are you just happy to get out of Dodge, so to speak, and you'll hire a broker, and if the purchaser pays for part of it, that's fine. Again, personal decision. You need to put that in your equation. However, no matter who you retain, they must maintain confidentiality of sale. This becomes particularly important in cases when we're dealing with specialists and we have a referral base at jeopardy. So again, that's something that all brokers obviously must maintain, and they will have their candidates sign an NDA or a non-disclosure agreement. Obviously, you go to a broker because A, they know the area, they hopefully have an inventory of qualified purchasers to accelerate your time frame. And all brokers know the dental lenders and they have established relationships. So if that purchaser needs to borrow money, as opposed to the borrower going to any bank on the corner, they can direct that purchaser to a dental lender and help work the deal and get the deal financed. Obviously, you're going to hire a broker that has local market understanding as it relates to what's normally done. Some brokers broker practices over the internet, so it's not surprising with technology. There's different ways to sell practices. Again, it's all about what do you need to get your job done. No matter who you work with, as a broker, you're going to sign a listing agreement. And that listing agreement could either be exclusive or non-exclusive. Exclusive means if you have not listed an individual as an exclusion, that broker is entitled to a commission. Non-exclusive means that that broker will get paid if they find the buyer. If they don't find the buyer and you find someone on your own, your accountant finds someone, and it's a non-exclusive, then you owe nothing to that broker. So exclusive agreements, meaning simply, no matter who buys it, they get paid. The contract term, usually most brokers will sign up for a year. Sometimes it'll be less than that under mitigating circumstances. So again, those are things you have to negotiate. Is there going to be a practice valuation? Is the practice valuation a freebie, or are you going to pay a fee? Are you going to pay a fee up front for the valuation, or are you going to pay that fee out of the proceeds of the commission when the practice is sold? So these are things that you need to discuss. And as I said, with a non-exclusive agreement, exclusions are, we're going to start with other considerations. Okay, I'm just going to go back to that. 1, 2, 3. There are some other considerations in signing a listing agreement, and one of the big ones is an exclusion contract. Exclusion means that if there are doctors that you've been talking to who maybe worked for you in the past who are still in the area, and they may or may not buy your practice, you might want to put their names down so that if in fact there is a sale to that individual, then you may not have to pay a commission. Brokers work at different levels of participation. Some brokers will just really be a finder, meaning they'll find your purchaser, and then when it's time to settle, they'll be there as settlement to get their check. If brokers are engaged and they're hands-on, do they provide sample contract closing documents to facilitate the transaction? For example, the practice purchase agreement, which we'll talk about in a few minutes. If you're going to remain as an employee, an employment agreement would be provided as well. It's important that your broker know who your team is. Working with your accountant and attorney at the beginning is, I think, a must. And as we've said in other programs, we really think you should retain dental CPAs and dental attorneys to really help get the deal done. We're going to start this again. Sorry about that. Getting a little raspy. Go back.
No problem.
1, 2, 3. Many brokers will work with your advisors, and we strongly recommend that they work with the CPAs and attorneys to help facilitate the deal and get it done in a timely manner. And so the reason brokers will provide sample agreements is to maintain control of the transaction. If they know the parties, they'll work with the attorney and accountant, but they want to be engaged and make sure all the things need to be addressed. And when we get into the practice purchase agreement, you'll see all the things that need to be looked at carefully. Obviously, as we said before, the broker will assist in obtaining financing for the purchaser. Now let's look at some of the key points of the practice purchase agreement. Some people call it an asset purchase agreement. So a practice purchase agreement is going to memorialize all the things that need to be done. And we provide all our clients, both buyers and sellers in our transactions, with what we call a pre-closing checklist. And there's lots and lots of little things that need to be done by both parties or one of the other parties. And we give this checklist out because one of the things that we find, if these things aren't done in a timely manner, it could hold up closing. And that's one thing that most sellers do not like. They don't like to be held up getting their money. But if all these little things aren't done in the prescribed manner, it could hold up closing. So that's why we provide that. So in a practice purchase agreement, obviously one of the big things, and we're going to talk in a minute about tax issues, is the allocation of the purchase price. How about accounts receivable? As I mentioned in my prior webinars, our practice values typically do not include cash, liabilities, or accounts receivable. So if there are a sizable amount of accounts receivable out there, is the buyer going to purchase them? Is the buyer going to collect them on the seller's behalf? If they are going to collect them for the seller, there's usually some kind of a collection cost involved. And if they're going to buy the AR, discounting of the balances needs to be accomplished. As Dr. Ashley mentioned when she sold her practice, credit balances can become an issue. How about work in progress? If the doctor is finishing some cases, that needs to be taken into account and be listed, access to the practice given, how are costs going to be shared, et cetera. Those things need to be dealt with. What about staff, unused vacation time, fringe benefits? That needs to be taken care of. If the staff is owed 2 or 3 weeks vacation, is the new buyer going to let them go on vacation, or is the selling doctor going to pay them for that vacation time because that new doctor needs them at the office? These are things that happen in discussion. Are there going to be remakes? If something isn't satisfactory, what is that criteria? Usually we have a clause that's covered up to 1 year post-treatment, and then we decide is the seller or the buyer going to perform those services and how is payment going to be handled. We also deal with family care protocol. If there is family in the area, how many family members can receive dentistry on a discounted or complimentary basis? Are there any contingencies, anything going on with this practice that someone's concerned about? What might happen is the attorney for the purchaser may require the seller to set up an escrow account for a certain amount of money. It could be related to treatment, things of that nature. How about the employment agreement for the associate to be, who is now the seller? What timeline? What's their compensation? All those things have to be factored into the equation. Now, unfortunately, when we sell a practice, we have to pay taxes, both federal and state. So let's look at the way most transactions are structured in a 100% practice sale. Most practice sales are considered asset sales. Tangible assets, the equipment, inventory, leaseholds. Intangible assets predominantly is goodwill. Restrictive covenant gets a small allocation, as well as patient list. Sometimes in specialty practices, it may be a telephone number that's part of that intangible asset allocation. So when you're selling a business, the seller wants to maximize capital gains because that's the least amount of tax to be paid. Conversely, the purchaser wants as many write-offs as possible because they can shelter their income and pay less tax. So you can see there's a dynamic that goes on. So the typical classifications of the various items are: goodwill is treated as capital gains. Equipment and supplies, restrictive covenant, and sometimes deferred comp with the consulting contract for the seller is considered ordinary income. So you may find that the buyer's accountant and attorney want to get more items to write off, and so they'll try to, increase the ratio of those three categories versus capital gains. Now, capital gains are still a write-off for the buyer, but not as the same as getting an immediate write-off with ordinary income deductions. Patient list is considered capital gains. The consulting agreement, ordinary income, leaseholds, and depreciation recapture happens in situations where a doctor has bought some equipment and sells the practice in less than the normal depreciation time, and they took a Section 179 or an aggressive write-off. They may have to pay some income tax there. The timelines for this are the following. For a purchaser, goodwill, it's a write-off. 15 years, takes a while. Equipment, 5 to 7 years. In some cases, it can even be more aggressive based on how the new accountant for the purchaser wants to allocate the assets. Restrictive covenant and patient list are 15 years. And the consulting agreement, which sometimes buyers, representatives like to use, is for 1 year. And if there's leaseholds that are still out there on the books, it's for the remaining term, whatever's left in that on that cycle, and dental supplies within a year. So let's, as we wind down, let's just talk for a second about the improbable, which could be your real world based on where you're practicing, where you're located. What happens if you cannot sell your practice as a total entity? And unfortunately, we've run across that. During COVID, post-COVID, there were many doctors who just decided for health reasons and other reasons, I'm done, I'm out. So we did a lot of these type of transactions because they just wanted to get out. So they were selling patient records to other doctors in the community, down the street, in the same building, you name it, but not the entire practice that normally most doctors would like to accomplish. So there's a couple methods. One is called the production or revenue acquisition method. Here, there is a payment of a fixed percentage of revenue from sellers' patients over a period of time. Usually, there's an initial down payment. We try to get 20 to 25% of that price, whatever we agree to, in cash. And sometimes what we try to do is get a higher percentage of revenue to the selling doctor because they're assuming most of the risk. For example, let's assume the practice grossed $500,000. We may try to get that doctor $300 to $350 as a sale price of those patient records over time, where maybe they're only giving the selling doctor 20 or 25%, which might be $50,000, $75,000. The rest of that is at risk. That's why we try to get a higher price, because the doctor who's selling the records only gets a small fraction at closing. So that's why we like to get a higher amount for our doctors. The payments are usually made on a quarterly basis. And of course, because there is the trust factor involved in a revenue or production acquisition program, there is an annual audit that can be requested by the seller to make sure that all the records are in order. And of course, if the purchaser had to pay the maximum value over usually a period of 2, maybe 3 years, they're going to win and the seller's going to win. So we do a number of those. There are certain states, however, that may have restrictions on this methodology, it could be construed as fee splitting, so you need to talk to your accountant about that approach if that is one that you're considering. Another one that does not involve with percentages is one where we're going to look at the value of an individual record. We usually look at the last 3 years of receipts, take an average. It can be a weighted average or an arithmetic average. There's no right or wrong way. We then divide the number of patients so we can come up with a per patient record fee. And usually that's paid over a 24-month period. That's paid after the second visit. So again, there are some options that are available to consider if you're having a hard time finding a buyer to conventionally sell your practice. So we covered a lot of ground today. I hope that this was worth the time that you spent with us. There's lots of things that need to be considered in this very, very important phase of your career in selling your practice. So when will you begin your transition? Hopefully, if you're going to think of selling next year, you better start right now and get that practice valued. If you have any transition-related questions, please feel free to reach out to us, Henry Schein, DBT.com, or dbt@henryschein.com as our website, or you can call us at 800-988-5674. And Dr. Ashley?
If you want to learn more about working with a profitability coach to review and improve your practice, please contact me at Henry Schein One, Practice Development Consultant, Maria M. Ashley, DDS, maria.ashley@henryschein1.com. My direct number is 480-339-0969. I work with 3 other practice development consultants. We cover different areas of the United States. So wherever you are, I will make sure you are directed to your appropriate consultant.
Well, Dr. Ashley and I want to thank you for spending the time with us, and I hope you found this program to be beneficial to you. I wish you lots of luck with your future plans. Thank you very much.
Thank you so much for that wonderful presentation. We did record tonight's webinar and will email out the recording sometime in the next week. We would appreciate your feedback via our survey that will pop up on your screen shortly. Thank you all for joining us, and we look forward to seeing you on future webinars.